Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about the impact of increasing your position size, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
I was curious about the thought process of, I know this is not a great market to double your position, but if you wanted to put two positions on or spend a little bit more money on your trade, what's the difference between doubling your position, paying double the transaction fee, or making your butterfly twice as wide and increasing your cost that way? Is one better than the other?
Relative to the amount of money that you could potentially return, the commission shouldn't really be as much of a factor, because consider this. The average return that I get on a trade is about $230, the average winner, where the average loser is about 115, 130 or 100. Yeah, something like that. So it's about almost a 2-to-1. And that's almost always a single butterfly. So if I were trading the ES, now that cost would be about $21 round trip. So what we're really talking about is about 10% of the winning cost. If it were the SPX, it would be about $9 or about 5% of the winning cost. So that would be the big difference, that you would be paying $20 instead of $9 for SPXs as opposed to one. Right? Or $40 instead of $21 for two ESs instead of one. Put that into perspective. So your max cost is going to be somewhere between 5 and 10%, regardless of different position types or asset types. If you put two on there, then you're just doubling your cost, but you're also potentially doubling your profit too. Is it more efficient to put on a wider one? I would say that the cost itself, the commission cost, doesn't factor as much into that equation as the overall risk that you're taking. That's a far more important factor when putting on width or number of flies or whatever. Is the total risk that you're taking as a percent of your capital.
So do you find it better to just place an entirely different bet and play your odds that way?
You could go for a slightly wider fly, but choose the SPX, lower commission. And as long as the total cost of the trade is within your max position size, you're okay. It's the max position size, ultimately, in the long run, that is going to determine the volatility of your returns. Of course, in the beginning, the volatility of your returns are going to be relatively high because you're new to this and you haven't really dialed in, that sort of thing. I've been doing it for a long time with thousands and thousands of trades under my belt, and my returns are generally pretty steady. So I have a good expectation. I keep to a specific certain range in terms of my max position size, and how I increase that position size. I'm very well in tune to that as well. To give you a good example of that, I'll show you my last account that you've probably seen before. All right. In the first, I guess 2/5 of this run, I was in a 1x position size. For me, that was somewhere around $200 to $230. And then about here, I increased by 50% to a 1.5x of that position size. And you can see that the volatility of my returns increased by almost 100%. This is what you're really trying to gauge and protect. I never even factor in the cost. To me, it's all about that drawdown, because the drawdown ultimately is going to determine my compound growth rate. If I were able to go to 1.5x and keep my max drawdown to 3.25, where it was, instead of 6%, then this equity line would be way up here, because every time I draw down, that's taking away from my ability to grow the account and to compound that growth. Ultimately, this is what you're trying to protect against. Everything comes back to this, the volatility of your returns, and that is directly related to the amount that you put at risk.
You mentioned this a few times, but it only just clicked for me. Now I understand what you're saying. You're betting twice as much, so your volatility is up.
Yes. So your drawdown increases, and that limits your growth potential. Now, for me, this is well contained. As long as I kept it below 6% and I was able to then whittle it down again so it was down to a manageable level, then I'm ready to start increasing my position size again. But you got to get beyond that. So that's what you're trying to achieve. You're trying to achieve the lowest possible volatility of your returns, so over the long term, your rate of growth will compound.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.